to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, Mr. AJ Brown. How are you doing, sir?
I'm doing well. Thanks for the introduction, Sip.
You're welcome. It's our favorite Friday of the month, right? Expiration Friday.
Today
It's
is expiration.
it's also not the yeah, it is the last Friday before Christmas. Is the market going to be closed on Christmas Eve? Is that usually the plan?
Usually it's a half day,
Okay.
but also today is something even more special than just options expiration. It's called quadruple witching. Only happens 4 times a year. Quadruple witching is not only when options expire, but it aligns with when stock futures expire, when index options and index futures all expire. So they usually are not on the same day, but 4 times a year they expire this way. And if you think about derivatives, SIP, derivatives are a transaction that is for a future transaction at the expiration date of the derivative. And so what happens, interestingly enough, is on the day of expiration, there's so much extra volume because all these transactions that were transacted on an earlier date, but are now finally doing the transaction on the underlying symbol. So the transaction on the earlier date is the derivative itself in the derivatives market, but it finally translates in some part to the underlying symbols. And so we get this huge spike of volume on quadruple witching because we have 4 different types of derivatives expiring today. And so for those people who use volume as a validation, I'm one of those people. I think volume is the great validator. Today is a day to not pay attention to volume because the volume is not because of buying and selling through organic reasons. The buying and selling is because of these expiring derivatives. So always on quadruple witching, we kind of don't pay attention to that day because it's a big spike in volume for the day.
Interesting. And I think you might have, really got the brain going there with all that explanation of the triple witching. Um, so does the end of the year is involved in that? Is that what the tripled witch is?
It's more of just an alignment of these expiration dates. It's like they have different expiration dates throughout the year, quarterlies and monthlies and weeklies. And it just so happens that in this time, in like, I think it's March, June, September, and December, they happen to all happen on the same day. It's like having a lunar eclipse and a solar eclipse on the same day.
Interesting. But that doesn't really affect too many of your strategies because as we've gone over in some of the examples, it's usually a couple days, a couple of weeks.
No, it doesn't affect our strategies. It just affects kind of our analysis of timing, right? We like to time and find things when things are at the bottom or the top. And one of the things we use is this volume validation to understand, is this a real signal for us to do something or not? And so that kind of screws things up, but it's one day and we can factor it out. And I've been factoring it out uh, uh, for 20 something years that I've been doing investing. But people need to be aware of it because otherwise they'll think it's a real signal.
Yeah, quadruple witching. Today is December 17th. The
Yeah.
market is kind of running up, running back down, and I suppose it's trying to figure out what to do next with all this information that's coming from all these different places.
So there's a couple of different things. We can look at it technically in a second, but let's just talk about what's going down, right? We've got the coronavirus Omicron, which people still, this is like an unknown and uncertainty. And last week we talked about the VIX, right? The VIX is a kind of a way for us to really understand how uncertain people are. So the VIX hasn't come down. If you take a look at my chart over here, the VIX hasn't come down to like normal levels around $15. It's still up here in the 20 to 22.50 range, which tells us that people are still very much uncertain, confused, and fearful, which they are, right? Because you've got this coronavirus thing going on and we don't know what the answer is. Is it going to, slow things down? Is it a no, is it non-news? We don't know. And the scoop is, this whole coronavirus thing is causing this chain effect. The we're talking a lot about these supply issues going on. What's happening is people are afraid to go outside, so they're staying home. They're setting up their home offices, which is why there's a whole bunch of shortages on like computers and chips, because they realized that their home computers were from like 1997 when Windows ME was still out and Windows 98 was just, coming out. And so they were all upgrading computers, which put a huge crunch on the computer market. And at the same time, people are like, well, I'm going to buy some furniture. I'm going to buy this. I'm going to buy that, because they got all this money because they're not going on trips. They're not going out to restaurants. And so all of a sudden, they're buying stuff. And so stuff is now getting clogged in our shipping, all the stuff that we buy, especially buying it online. It's causing this huge thing. And now there's a demand for stuff, and we can't deliver stuff. And just basic economics, when there's a high demand and a low supply, prices go up. And so the Fed is having this hard time trying to figure out, is it real inflation, or is it inflation that's transitory because people are buying stuff more than they usually buy stuff? And we can, as a world, we can only deliver so much stuff. It's easier to deliver experiences like restaurants, because if you think about it, going out to a restaurant is not just about the food, it's about the experience, right? That's what people pay for. Because if you think about it, you go out here where I live in Washington, D.C., you buy breakfast and you wind up paying $30 for freaking eggs and coffee, which, doesn't cost anything. So it's about the experience, right? And experiences are cool because they don't clog up the supply channels. So the Fed doesn't know what to do. The Fed announced that they're going to start paring down more of this quantitative easing, which means they've been pumping money into the markets by buying securities, right? And so they just put an IOU on their little digital ledger and say, I'll give you this, I'll buy this security with this made up money, which is how they inject money into the market. And they basically announced that, hey, not only are we going to cut back on doing that, we're probably going to stop by March instead of stopping by June. And in fact, not only are we going to stop buying stuff, we may start selling it back, which means we're going to take the IOUs off and we're going to start sucking out extra money from the market. So all this money that everybody's talking about being had, not, of course, there's an there's an imbalance. We know that some people have no money and a lot of people have a lot of money, but some of that money is going to get sucked back out by the Fed. And in addition, they're going to start raising interest rates. They've hinted at that, like possibly 3 interest rate hikes. Now, Wall Street kind of digested that news positively, saying, hey, that means the market's doing well. But it's just that they're playing a very interesting line, and it's causing a lot of confusion, uncertainty, and it all comes back to this whole pandemic woes. Like, what the heck is happening with the pandemic?
Yeah, and and next week there'll probably be less money being put to work. People are traveling, they're going home. Um, the like we talked about in a previous episode, those guys that or those people that have no lives and want to trade, all day, they will be moving the market if they can.
Yeah.
So interesting to see what will develop.
We will see that next week. Starting next week, we might start to see how the balance-minded folks will start be spending time with their family. They'll be shutting off their computers, and those intense traders will start moving the market. So starting next week, we'll start to see those swings. At least this is historically what has happened. And the week between Christmas and New Year's is always one of those weeks where weird things happen because it's a few voices speaking very loudly. And then, of course, around January 2nd, January 3rd, things get corrected into a more like stable thing. I want to talk really quick about the S&P 500. I got my chart up here because we talked about kind of the soft issues, the issues we hear about from the talking heads. But let's also take a look at it technically. Now, if I go back 2 years, you can see that we've, since the initial, scare of the coronavirus, we've been in this upward trending channel for almost 2 years now. In March, it'll be 2 years that we've been in this upward trending. And just recently, we've been more than often testing this lower threshold. In fact, we had to adjust down our lower threshold because we got 2 tests of that support. Let me go ahead and zoom back into the last 6 months. We also have this overhead level. Now, we had the overhead level a few months ago, and we actually talked about it on this show as being a whole bunch of people who put their money into the markets. And then immediately after doing that, and that's because they had FOMO, right? They had fear of missing out. They were like, everybody's putting their money into the markets and making money, so I'm going to do it. And then just when they did it, the market pulled back. So now these people are like regretting their life's decisions and things like that. And as soon as that recovered, we saw a few days of pause as those people who were fraidy cats to begin with took their money out, and then it kept going up. Well, happened again, right? We saw, oh gosh, hey, the market is still going up. I'm going to put my money in afterwards because I have a fear of missing out. And sure enough, the same thing happened again. The markets are getting a little bit more uncertain and fearful. And so now we're seeing a lot of distribution. We can't seem to get back above this line. So I'm watching carefully this line at 4,700, and it's about 4,750 on the S&P 500. I want to know, it's going to be very decisive if we can get above that line. That means that all the distribution's out and we're going to start going up again. And there's this creeping level up of ascending support. It's actually creating kind of a consolidation, which is also going to be interesting as we watch forward, because as we consolidate, it's kind of like a pressure cooker. And the more we consolidate, it's like the more you compress that piece of coal, it's going to explode into a diamond. But which way is it going to explode, up or down? I don't know. I'd rather it gracefully go up or down. So I'm watching these 2 thresholds. 4,750 on the S&P 500 as a top threshold, and this ascending line of support. If you draw a line from this level here to this level here, you'll get this diagonal line. We're watching carefully, and we hope that in the next week or so, it'll gradually go above and go down. We don't want it to get in here because then it'll be something very surprising. We'll want to hedge all of our investments against surprises because that compression usually causes big breakouts. And at the same time, like we mentioned, in the next 2 weeks, it's going to be insanity. And so you can't trust anything in the next 2 weeks. At least I'm not going to. But yeah, we're looking at that yellow line at 4,750 and that ascending line. Just the broad market analysis. It's always fun.
Yeah, I mean that looks like a ideal consolidation setup, especially with like the next 2 weeks being probably lower volume and things like that. So definitely will be looking for that breakout to the upside or to the downside,
It's a
in
different
January.
It's definitely a different way that we have to play this. So a lot of us who are premium traders, which I'm primarily a premium trader, we need to hedge our investments. We need to be careful about this. But now, if you want to switch over and trade the breakouts, there's massive money to be had on the breakouts.
Well, yeah, but that's not what we do here at Trading Trainer. So let's go into today's topic. Yeah.
Yeah, let's talk about this. They're called SPACs, SPAQs. Um, there's been a lot of a lot of details in the news about SPACs. In fact, these are basically investment ticker symbols, right? And you can invest in these just like stock symbols. And a lot of people, especially technicians who don't pay attention to the fundamentals, they've been investing in these things. But you got to kind of understand, and the reason why it's been coming up in the news is because there's just so many of them out there in 2021. I mean, there's always been a few of these companies out there over the existence of the market, but they've like quadrupled and quintupled the number enough that they've got the SEC on edge, right? The SEC kind of cracked down on these guys in the beginning of the year. And then after the crackdown happened, they multiplied again. And this past autumn, there's been so many of them. And do we have a video of the SEC guy? Kind of, I think it's a 2-minute video. Can we play that video?
Yeah, we'll play it right now.
A lot of people are wondering what SPACs
But what in the world is a SPAC anyway? Suppose a group of strangers came up to you and said, I have a company that doesn't do much of anything, but sometime in the next 2 years, we'll merge with another company. I don't know what that company is yet. Would you invest in the stranger's company? What if I told you that if the strangers complete a merger, they get to pocket 20% of your investment? That's essentially what a special purpose acquisition company, a SPAC, does. They're blank check companies that raise money from the public through initial public offerings. They generally have 2 years to find and merge with a target company. Once they find a target company, SPACs often raise more money through transactions known as private investments in public equity, or PIPEs. These deals give the new investors, mostly big institutions, not like you and me, an opportunity to put money into that target. But these new investors, the PIPE investors, they often can buy those shares at a discount to what the share price might be after the target merger. So they receive a benefit that's not available to ordinary investors. The result? PIPE investors often get a better deal than you, and the value of your investment may be further diluted. Thus beware. There are lots of costs that regular investors are bearing, whether it's that 20% sponsor fee, the dilution from the PIPE investors, and fees for the bankers and financial advisors. It may be that those fees are coming out of the retail public's investment dollars. We need to make sure that investors in SPACs are being protected. Look, you as an investor get to decide about where to put your money, but companies raising money from the public have to provide adequate disclosures. I think we can enhance the disclosures that companies raising money via SPACs make. I've asked staff for recommendations about how we might update our rules so that investors are better informed about the fees, the costs, the conflicts that may exist with these SPACs. We'll also work to hold bad actors accountable and keep a close eye on all the parties in these transactions. Because at the end of the day, we need to ensure that investors are protected.
So yes, the scoop is these SPAC companies are popping up. Individual investors see them, especially technicians, and get all excited because they can actually kind of manipulate the market. But at the end of the day, especially after all these PIPE investments come in, the losers are usually the company that has been acquired and the small investors that the SPACs got interested in the first place. And the winners is the SPAC themselves and then the PIPE investors. So you have to be very careful as individual investors. Thankfully, these things are not optionable, at least not at this point. But man, if they ever were, it's going to cause even more. You got to watch out because ever since the exchanges went public, they've been looking for more things to sell. And so, for instance, if you can remember back about 10 years when we had the Great Recession, that was because they created these financial instruments that were of these junk bond mortgages, and they kind of hid the junk bond mortgages into these financial instruments and got regular investors in the markets to invest in them. And so when the actual people were investing, they didn't realize they were investing in really crappy mortgages. Well, you just got to know what you're investing in. A lot of us technicians just like to buy and sell and make the money on the difference, but always know what the underlying is. The SEC is really worried about these SPACs because they really have no purpose of a company. It's like a whole bunch of, a bunch of people who get together and they're like, we could probably acquire a really big company. And one of the big companies now, I think it was BuzzFeed. BuzzFeed got acquired by a SPAC, and then BuzzFeed's been like, I mean, not only were they got piped, for lack of a better word, and so did the little investors who invested in the spike in
Yeah,
the SPAC.
yeah. From my understanding, it's kind of like a quick way to go public, right? Like these smaller companies, rather than being acquired, they'll create this formation of a company and then list it as the spec. Some of the names that I'm looking at that I think are popular are, it sounds like DraftKings is a spec,
Mm,
Virgin Galactic is a spec, Nikola, the Tesla truck competitor, came out as a spec, Open Door, and even the new Trump media organization, I believe, is a spec.
right.
Um,
So just buyer beware. When you're talking about the markets, it really comes down to buyer beware. So we always want to know what we're investing in on the underlying symbol.
So so the fact is they're not optionable. So it's not anything that you're looking at or putting on positions in.
No, but I get asked about this often, so I wanted to cover it because I like investments all over the place. I've got my crypto, I've got all kinds of things, so I keep my fingers on all. It all winds up being related at the end of the day.
Yeah, and that some of them are those news friendly stories that will just run on Bloomberg, CNBC over and over
Yeah.
again, and it's just inevitable.
We
All
talked
right.
about correlation a couple weeks ago, so this definitely correlates.
All right. So, with that being said, if anyone else has questions on the SPAC stuff, feel free to drop a comment, send a DM, follow up. Any of that will work. I think AJ will be happy to answer it, but we don't really cover that much. But there's the rundown on SPACs. But what we do cover are, what do we want to talk about? Pulte Homes. We got a position in Pulte
Let's
right now.
So on the opposite side of a SPAC is a company that actually does something, right? They actually the Pulte Homes builds homes. They're one of the biggest builders, and I've been doing some investments on there. So I wanted to share with you guys an investment I did on Pulte Homes. And then I also wanted to talk about what we could do moving forward with Pulte Homes. So here's the chart on Pulte Homes. As you can see, Pulte Homes is one of those companies that I like to invest in because it's boring. It just kind of goes sideways. It gives out a very large dividend. So people invest in Pulte Homes, not necessarily because they want the stock price to go up, because they are just collecting their quarterly income. What I do is I go ahead and I sell my premium against it. So let me go ahead and share this little slide set to you. There we go. So on the afternoon of October 28th. So if we take a look back, October 28th was right around here, November 5th, October 21st, something like this. Boop, boop, boop. Right around here, October 28th, this day. On October 28th, I bought to open some contracts. Now you're going to notice that I didn't use any hedging here. This was a quicker trade for me. I bought to open these back month options. I call them kind of stock substitutes. They're cheaper, right? And they act just like the stock. Pulte Homes, January 2023, $30 calls. I only paid $19.30. And that's because I wanted to get it at a discount, because Pulte Homes was trading up there around $50. I also put my stop loss order in. I always put a stop loss order triggered on the underlying symbol so I can make sure I reduce my risk, right? All right. And then what did I do after I bought those things? As usual, I waited. I waited patiently. All right. Now let's fast forward to November 10th. So coming back to the chart, Pulte Homes, it was right about here, October 28th, that we did some buying. And so I waited till about November 10th. That was a couple days later. It was up here. November 9th, it was on this little day right here. After finding what I thought was a top, no problem. I sold some premium. I sold some Pulte Homes November, so expiring November 19th, a couple days ago, about a month ago, actually. $51 calls, and I got $1. So that created for me an instant dividend, basically. I didn't have to wait for their quarterly dividend. I got my own. I gave me a discount on that back month option. It also created a profit buffer because now my cost basis has been reduced. So I sold this premium and I got all the benefits from it. And then I waited. Now, fast forward 9 days to when that option expired. I actually got exercise because Pulte Homes, as we saw on the chart, kept going higher. I thought it was done, and it actually kept going higher. And then so when it went higher at the expiration date, it turns out the person who bought my stock or bought my option from me, they said, "Hey, I'm going to go ahead and ask for you to give me that Pulte Homes stock, and I'm going to pay you $51 a share." And I was like, "Uh-oh, I didn't have the Pulte Homes stock, but I had those Pulte Homes January 2023 $30 calls, which means I did some exercising." I went over to the person who sold me those calls and said, "Hey, I'm going to go ahead and exercise you at this moment. I'm going to get some Pulte Homes stock, and I'm going to pay you $30 for it." So they gave me the stock. I passed the stock on to the other person, and I kept the difference between the $51 and the $30. So I got to keep $21 a share. So basically, I got cashed out on November 19th. By the way, it sounds like that's complicated, but that happened all behind the scenes. My broker did all that for me on November 19th. I didn't actually do anything. My broker saw that I got exercised, and they looked in and they exercised my calls. It all happened, what I say, auto magically, right? And so I didn't have to do any action, but I got that $21. And then on that weekend, I realized, hey, I got cashed out and I wound up making 13.8% in just a few days. So when all was said and done, I made 2 trades. One was on October 28th. The other one was on November 10th. And on November 19th, the third Friday of November, I walked away with a payday of 13.8% ROIC. It doesn't get any easier than that. So I'm going to share with you some ideas. Of course, I want to throw this disclaimer up on the screen telling you that I'm just giving you education. I'm not trying to give you any advice, and I really want you to do your own due diligence. Read this disclaimer thoroughly. But let's talk about what's happening with Pulte Homes right now. Pulte Homes is looking like it's at a little bit of a top. It's testing this level of resistance. I got myself my little indicator using the fast MACD. We talked about that a couple shows ago. So if you haven't checked out some of our replays of our previous shows, please go and do that either in our YouTube or our Facebook channel. And while you're there, hit the like button, the subscribe button, and turn on your notifications so you know about our live shows coming up. But now's a great time to actually either sell to open, meaning short some shares of Pulte Homes. And, when it comes to the number of shares, I want you to do your own risk analysis. 500 shares is what I would do in my portfolio, but maybe you want to do a different amount in your portfolio. So either short some shares of Pulte Home, or what I like to do, like you noticed what I did before, I'm going to buy to open some Pulte Home $75 puts. So when you think about it, last time we did a trade, we had a bottom and then a top. And so we bought some back month puts, sold some front month puts, and then wound up making money that way. This time, we're going to do it opposite. So here, we're going to short some Pulte, or we're going to buy some back month puts. And then we're going to wait. We're going to protect ourselves with a stop loss. I have Delta Airlines there, but I meant to say Pulte Home. And then after waiting, when we get our fast MACD crossing, we're going to sell the front month option. So what we're targeting is the Pulte Homes December $45 puts. Now, December, that's today. So we might actually even go to the January 2022. It all depends on timing, but you're going to do basically the near term, whatever is about 3 to 5 weeks out. And we're going to buy to open some protection. Last time I didn't use protection, but I want to always use protection here. Call options. And then I'm going to wait. I'm going to see what happens. And of course, when I can, I'll roll that protection out. So I'm going to reevaluate and I'm going to do it again and again. So let's bring back the chart and kind of draw on the chart so I can make sure that's pretty clear for everyone. Let me get rid of this chicken scratch and let's add some new chicken scratch. So what I'm talking about here is let's go ahead and do one transaction at the top here where we're selling some back month puts or shorting some puts or buying some back month puts and then waiting for it to dip back down. And once it's done dipping back down, that's when I'm going to buy some protection. And in this case, I'm going to buy some calls and I'm going to short some front month puts. One transaction here, two transactions here, and then wait. And that's all I'm going to do. And that should bring in a nice return for me.
Question on this one. I don't see any of the support resistance lines. Is that something that you freehand, or some charts have it, some charts don't?
I didn't draw them in, you're right. But I just did kind of with my chicken scratch, do a little bit closer analysis. What I like to do, if you're part of my program, and we could talk about the program in a hot minute here, but if you're part of my program, I really like to put some retracement lines on there to get a good idea of my boundaries. And we've talked about that as well early on in this program. So kind of going with this particular type of setup, probably with $46 and maybe 25 cents, $46.50 for support, $55.50 for resistance. I'll just go ahead and firm this up for you guys so you're following along with me. There you go. There's your support. There's your resistance.
I just imagine someone would ask that, right? That we, cover it, because it does help. It does help me see where those orders or those call levels that you want to, pick up in the future.
The big thing for this one is instead of doing our typical, which is using calls, we're using puts. So on this trade, we're using a deep in the money, far out in time back month put. On this one, we're using a near term at the money front month put, and we're protecting or buying our protection with a call. Usually it's topsy-turvy. So I wanted to feature this one today because we can do it both ways.
Yeah. And so what is that? How far out are you looking? So is that going to be like the next 2 or 3 weeks we're looking at?
So I'm actually just making sure I got my signal to buy those back month puts just a few days ago. I'm just making sure, and it looks like today, but I usually wait till Monday. I like to have people digest what's happened over the weekend. So on Monday, I'll probably be buying some back month puts, and then I'll wait patiently, and I'll then sell the front month puts, buy the calls. I'll probably be looking at the next 3 weeks to do step 2. And then you just wait until the third Friday of January for your payday.
Yeah, I like this one. Let's keep an eye on this one. Let's, bring it up in the next couple of episodes. This is a great setup, in my opinion. Some of the other stocks that we've covered in the past, maybe we can run through some of those real quick just to see if there's any setups.
Yeah, let's do a lightning round. So Delta Airlines is one that we featured. And Delta Airlines is coming down for a double bottom. Delta Airlines, American Airlines, they're all in front of, they're in the news because they're all in front of the legislative branch testifying about masks on airplanes. Not sure that's going to affect any of the stock prices, but we're, perfect opportunities for us to either buy some airline stock or buy some back month deep in the money call options that would mimic the stock but be at a cheaper price. So if you've got them already, great. You're in that point where you're just waiting. We're waiting for it to appreciate a little bit. We'd like it to actually appreciate maybe above $42.70. Once it's above $42.70, we can sell our premium, buy our protection, and go from there. So we're just in the phase of looking for the best time to do that.
What else we got? Do you want to piggyback on American or CLF? Sure.
Yeah,
We did.
CLF is in the same place. So people have purchased their stock or they've purchased their back month calls. There's another opportunity to do that, and now we're just waiting for it to get above $23.35.
Wonderful. What else?
The toy company.
Mattel. Yeah, that was like one of the first ones we ever did.
Yeah. So the toy company, we sold our premium and we bought our protection, and now we are waiting for expiration, which is today. So more than likely, it looks like it's going to expire worthless on us because we've got our $23 calls that have been sold. So we're going to get to keep that money, and we're going to get to do it again for next month. In fact, it looks like I've got my little green arrow here on the Fast MACD. It looks like I'm going to have an opportunity to do this again in January. So it's working out like a playbook.
All right, we're gonna make a note of that. Mattel with the January play. And then I think maybe just one more might be the American Airlines, although I'm assuming it's kind of piggybacking off of the same Delta setup.
Absolutely. American Airlines is doing the same thing, double bottom. It's giving us another opportunity to do dollar cost averaging on the back month option. Or we could just wait, or if you haven't gotten it yet, you still have an opportunity to start getting in on the step 1 trades.
Yeah, and I like American Airlines because it's got the lower price stock, that $17. Not too bad.
That's not bad, and you got to size these things based on your portfolio and based on your risk, appetite.
All right, AJ. Well, if anybody's new that's watching this, as always, AJ does a live trading webinar, or it's actually a replay of a live that goes on, every hour or so, where he talks about a lot of these strategies, gives more examples, and really breaks down the entire process of utilizing these, ideas and strategies for your portfolio, dependent of size. So feel free to hit that link in the comment section. Also, we do broadcast every Friday, so feel free to hit that subscribe and like button so that you can get those notifications. And if you have any ticker specific that you yourself want AJ to look at, go ahead and drop that in the comments. We'll put it into the mix. Anything we should be looking at, moving forward? Or are we just kind of, because it's quadruple witching, we're letting that settle and then kind of hitting the analysis next week, the week after?
I think we're going to hit the analysis the next week, and we're going to pay attention to those thresholds that I gave us in the broad market. So when we take a look at the S&P 500, we're going to watch that little wedge formation, see if we can either smoothly get out of that, or if not, we're going to prepare for some drastic breakout action. And we're going to watch that we're going to see if history plays through and if we get some crazy trading in the next couple of weeks. So next Friday and the following Friday, it'll be fun.
Looking forward to it. So with that, I guess we'll go ahead and close out the episode. Appreciate everybody tuning in, and hoping that everyone enjoys a good weekend. We'll see you next week.
See you next week. And next Friday, what is the date next Friday? Next Friday is Christmas Eve. I think it's going to be an early day for the markets.
Yeah, well, we'll keep it short so everyone can get back to their families and hanging out.
Yeah. All right.
All right. Take care, guys.
Bye, everybody.